A little more about who we are and what we do. We are a membership-driven organization. We produce a lot of data, research, and insights, and we actually have everything available on our website, gold.org, for free. We don't sell anything. We don't really have a product to sell. All you need to do is use your email IDs to log on to our website and access any data, insights that we keep producing from time to time to build your understanding on gold, to do your own analysis on gold and its performance through various tools that we also have on our website. Now, coming to gold, like I said, gold has been with us for centuries. And through the analysis and estimates that we produce, we estimate that the above ground stocks for gold are in the range of 212,000 tons. Obviously, a large chunk of this above ground stock of gold is in the form of jewelry. So 45% of our stocks are in the form of jewelry. Bars and coins, including gold-backed ETFs, account for about 47,000 tons of gold. And if you look at central banks, including RBI, all of whom have some amount of gold, this accounts for about 36,000 tons, or 17%. Gold is also found in other categories, and that is about 15%. What do I mean by others? So all your mobile phones, your laptops, computers, the servers that run, artificial intelligence-backed data, all of them also have gold. Besides which, a lot of medical equipment, medical devices, gold used in dentistry, and also gold used for medicinal purposes accounts for this other category, which is about 15%. In terms of the proven underground reserves for gold, we estimate that to be 59,000 tons. So gold is scarce, but the financial market for gold is fairly large. Now, what drives gold demand? So we've categorized gold demand as strategic and tactical. And within strategic, one of the drivers for demand is economic expansion. We've seen that when economies do well, the demand for gold goes up. If you look at periods of growth where an economy has done well, those are also the periods when gold or the demand for gold is quite high. Similarly, when there are periods of risk and uncertainty, whether it's through financial crisis or geopolitical issues, gold actually does well in times of these uncertainty and risk periods. If you look at tactical demand, one of the drivers is opportunity cost, whether it's through interest rates, through other currencies. What affects the demand for gold is the opportunity cost of holding gold versus other asset classes. And last but not the least is momentum, whether that's through price changes or volatility in other asset classes. This is also a driver for demand. So gold is a global market. Wherever you go today in the world, there is gold in some form or the other, whether it's through bars, coins, ETFs, jewelry. Every country, every population around the world has gold in some form or the other. But majority of this demand for gold is in the emerging markets. Countries such as India, China, and the Southeast Asian subcontinent account for about 71% of gold demand. The balance demand comes from developed world, and that's about 29%. Now, gold has a dual nature. It's both a consumption asset and an investment asset. So if you look at the consumption demand of gold, whether it's through jewelry, annually it's about 35%. And the annual net average demand for gold is about 3,000 tons. 7% of this demand is for technology. Uncertainty, which leads to investment-led demand, is about 39%. And central banks account for about 19% of annual average demand. Now, if you look at India, Indians love gold. Wherever we go, there are many occasions for us to buy gold And we have been buying gold for so many centuries that some people actually have gold that has been passed down to them from generations. Having said that, our average demand for the past 20 years has been around 750 to 800 tons. Most of it, of course, is in the form of jewelry. Some of it is now picking up as investment demand through bars, coins, and ETFs. And central banks, which is RBI, has also been buying some gold over the past 4 or 5 years. But the drivers for demand in gold are a little different. We did an econometric analysis, and we found that in the long term, the driver for demand for gold is income. For every 1% increase in income, the demand for gold actually goes up by 0.9%. And when prices go up, the gold demand actually comes down by 0.4%. In the short term, the driver for demand, the drivers of demand are a little different. When we have a good monsoon, we've seen that the demand for gold goes up. But when the government raises taxes and duties, the demand actually comes down a little bit. Similarly, inflation actually helps gold demand. People stop buying, other items and goods, but start parking money in gold. And gold prices, of course, they also affect demand in the short run. Now, why am I talking about the strategic case for gold when Indians have so much gold through jewelry? There are various occasions, whether it's, the birth of a child, weddings, anniversaries. There is no dearth of an occasion. And there are, of course, festivals, right? Diwali, Dhanteras, Akshaya Tritiya. These are all gold buying festivals where people think it's auspicious to buy gold. So I think it's important to understand, gold's attributes. The general perception is that gold is another commodity. It's only a tactical hedge, and there are better ways to protect against inflation, or that gold just preserves capital. But what is gold's role in a portfolio? Whether you have a small cap, mid cap, large cap, or you just invest in fixed deposits, there is a portfolio construct today that's happening around the globe. And what is gold's role in that portfolio? And therefore, what is the strategic case for gold? I think these are important things to understand. So let's take a look at what gold does. We'll take a look at gold in a portfolio from 3 aspects. One is returns, the other is diversification, and the third is liquidity. What does gold do to a portfolio from these 3 aspects? So we did, from an Indian perspective, we did an analysis on what returns actually gold provides in INR terms. And we compared gold over a period of 1 year, 3 years, 5 years. This year alone, gold has reached 40 new all-time highs. And we've seen that in a long-term period, gold actually gives you returns in the range of 10 to 15%, which is quite comparable if you look at equities, which we all know are fairly volatile, whether it's in the short term or in the long term. In periods of high inflation, we've also seen that gold historically performs well. Gold has also kept up with money supply, whether it's through interest rates or CPI-led inflation. Our analysis shows that gold has done well. And if you look at diversification, gold does well when economy is doing well, which means when equity markets do well, gold does definitely well. But when equity markets crash, gold does better. So equities are negatively correlated, or gold is negatively correlated to equities when the market is not really doing well. Now, if you look at bond markets, the correlation with bonds actually is positive when there is risk and uncertainty in the markets. So we've seen that when there is no risk and uncertainty, bonds and golds are not really positively correlated. But when there are periods of risk and uncertainty, gold and the bond markets go positive. Similarly, if you look at geopolitical events, we've taken events right from the Gulf War, the 9/11 bombings that happened in the US, Brexit, Russian invasion, and last year's Israel-Hamas invasion. And we've seen that in periods when there is a geopolitical event that happens anywhere in the globe, there is a flight of money into gold. So gold does well. Likewise, if you look at periods of systemic risk, and again here we've taken the the 1997 LTCM crisis, the Great Recession, sovereign debt crisis, Brexit, COVID, and the COVID pullback. In all these periods, gold actually performs well. Periods following a systemic sell-off, again, are good for gold, because we've seen that gold has done well in these time frames. Now, if you look at liquidity, gold is actually a very liquid asset. We've done a comparison with Indian equities, bonds, USD, and S&P 500 and US Treasury bills. Gold gets traded a lot more, not just through its demand for jewelry, but also through ETFs and various other products, OTC products, and therefore about $120 billion plus of gold does get traded. In 2023, gold performed well. But if you look at 2024, gold is one of the best performing asset classes. Year to date, I think it has given 21% returns just in INR terms. And if you look at on an average return basis, it's about 17%, which makes it one of the best performing asset classes. It's also important to understand key risks when it comes to gold, because gold doesn't conform to traditional valuation methodologies, and therefore, it doesn't give you a coupon or a dividend like equities and fixed income products. So it doesn't actually, it's also therefore not as volatile. Over a medium term, we do recognize that gold has sometimes underperformed. But on an annualized basis, if we compare it with Indian equities, then the returns are comparable, where gold has given about 12%, 12.5%, but the volatility as compared to equities is much lower at 15% versus equities at 21%. Now coming to portfolio impact, we did a hypothetical portfolio with just equity and debt, 70-30 equity and debt, and we added gold ranging anywhere between 7.5% going up to 15%. And what we realized that adding gold to portfolios definitely improved risk-adjusted returns. So if you look at this table here, the volatility in the portfolio definitely goes down, the reward to risk goes up, and annualized returns also go up. We've also seen that adding gold beyond 15% to a portfolio doesn't really give you incrementally higher returns. So, although we are not wealth advisors, we don't recommend portfolio allocation beyond 15%. How to invest? I think the most important criteria is to ask yourself, what is it that you want to do with the gold? If it is for a wedding which is happening in the family immediately, please, by all means, buy jewelry. But if it is for a child's education or a wedding which is 10 years from now, then you should look at products which are easy to store, which don't cost you in terms of storage through a bank vault, or the cost of insurance that you would pay to keep that gold at home, and also whether you would like to touch and feel the gold through bars and coins. We also in India now have products called gold ETFs, which were launched in 2007, but have picked up significantly well and are regulated. They also have, you can buy as small a quantity as 0.01 gram through 1 unit of ETF. We have gold ETFs, you have multi-asset funds, and you have gold fund of funds. So for those of you who are distributors here, the gold fund of funds or multi-asset funds ensure that the clients who don't have a demat account can also invest in gold. Recent outlook and performance, of course, gold has done well. Like I said, it has reached new highs almost month on month. 40 new highs is a big thing. But in terms of supply and demand, central banks have been one of the largest buyers this year. RBI alone has bought up to 77 tons of gold end of October, and we do hope that central bank buying continues. Supply, we have record mine supply on the cards, but recycling would also respond to prices. And investment demand is picking up, whether it's geopolitics, slowdown concerns, or the America First policies. All of these would determine how gold would actually look. Now, gold's real return is greater than what you thought. Its contribution to managing portfolios is well established, but contribution to portfolio return is not. And we have tools, again, these are available for free. It's called the Gold Long-Term Return Expected Model, and you could play around with it, use your own macroeconomic indicators to figure out what gold will be like in 2025. We've actually just an hour ago published our outlook for 2025, and we think that gold is poised to have the best annual performance in more than a decade, reaching up to 40 new historical highs and up 29% year to date. Of course, behind this is central bank and investor buying, which have offset more than a notable deceleration in consumer demand. And as we look forward, I think we now want to see what Trump's second term may mean to the global economy. Current expectations of GDP yields and inflation suggest a positive but moderate growth for gold in 2025. And upside can come from lower rates, rising volatility, continued above average central bank gold demand. However, conversely, higher for longer rates, faltering consumer demand can bring headwinds to gold. With that, I end my presentation. Thank you for being a patient audience. Thank you.